Have you ever wondered whether the global financial system, this giant steel and concrete fortress we pretend is unshakable, is actually held together by something as fragile as one single number? Not gold, not the dollar, not the stock market, just a quiet little figure beating like the tired pulse of an aging heart. And last week that pulse spiked, and suddenly the entire world had to pretend it wasn't panicking. The number that shook the world. Just as economists were busy arguing about interest rates, recession odds, and whatever new buzzword they invented that morning, a completely different alarm rang. A number that had barely moved in decades suddenly shifted, loud enough to make global markets sit up like someone slapped them awake. That number? The 30-year Japanese government bond yield. It jumped to 3.41, a level so unthinkable that multiple generations of economists assumed it had retired and moved to a nice beach somewhere. A tiny number on paper, but symbolically? A warning shot fired straight into the engine room of the global financial ship. Because when Japan's long-term yields rise, it's not a domestic issue, it's a global tremor. Why one Japanese number terrifies the world. To understand why markets suddenly forgot how to breathe, we need to rewind about 30 years. Back to the moment Japan's economic heart stopped beating. Early 1990s, the mother of all asset bubbles burst. Real estate collapsed, stocks collapsed harder. Entire skyscrapers were worth less than mid-size American banks. A once high-flying economy turned into a nation of cautious savers. Consumption shrank, investment froze, the population aged faster than any developed nation on Earth. 10 years passed, then 20, then 30. Still no miracle. The birth of the world's cheapest money forward. So the Bank of Japan did what any desperate central bank would do. They hooked the economy up to financial life support. Interest rates? Cut to zero. Then negative. Then the printing machines were fired up like it was an Olympic sport. The BOJ started buying everything. Government bonds, corporate debt, ETFs, basically anything that could fog a mirror. Japan became the home of the cheapest money on the planet. And when you control the cheapest capital in the world, the entire world comes knocking. Investors borrowed yen near 0%, flipped it into dollars or euros, and poured it into assets everywhere. Japanese liquidity quietly inflated. US real estate, European bonds, Southeast Asian markets, emerging economies worldwide. If there was a bubble somewhere, chances are Japan helped blow it up. Then the impossible happened, but every river eventually changes direction. When Japan's 30-year yield hit 3.41%, global markets felt the temperature drop instantly. Why? Because higher yields mean one thing: yen borrowing is no longer cheap. And when cheap yen disappears, the investments built on it start sinking. When profits evaporate, markets do what they always do. They pull back. Hard. That means selling US stocks, Chinese assets, European bonds, Southeast Asian real estate, and pulling funds back home to Japan. Imagine a dam that flowed one way for 30 straight years, suddenly reversing. That's what global capital is doing. The three historical burdens forcing Japan to change. Japan didn't tighten because it wanted to. It tightened because it had no choice. Three massive burdens cornered it. One, a debt bomb. 230% of GDP, Japan is the world's most indebted major economy. A 1% rise in interest costs equals a fiscal earthquake. For decades, zero rates were the only thing keeping the budget from imploding. 2. Inflation plus a collapsing yen. The yen sank to 152 per dollar, making imports painful. To stabilize it, Japan needs higher rates, but higher rates detonate the debt bomb. It's a lose-lose trap. 3. Geopolitics. Rising tensions with China, Taiwan risks, and a new regional arms race forced Japan to boost defense spending dramatically. Money printing is no longer an option. Japan is now balancing between a currency crisis and a debt crisis. There is no easy exit. When Japan wobbles, the world shakes. The US feels pressure because investors sell US bonds to buy yen. Asia feels outflows. Europe faces higher borrowing costs. Even emerging markets like Vietnam feel the tremors. The global financial system isn't separate rooms, it's one giant web, and Japan is one of its anchor points. When an anchor cracks, the entire structure sways. The domino effect, no one prepared for. The real danger isn't that Japan's yields rose. It's that the entire world built economic strategies assuming they never would. Funds, banks, governments, they all relied on Japan's eternal cheap money pump. But when the foundation moves, everything sitting on top becomes unstable. Higher yen borrowing costs kill the borrow cheap yen, invest high elsewhere model. Once yields creep up, profits vanish, positions unwind, assets get sold, sell-offs trigger algorithm sell-offs. A ripple becomes a wave becomes a storm. This already happened in July 2024 when the BOJ merely hinted at policy changes. Nasdaq plunged, Asian markets bled, the Korean won collapsed, the Thai baht slid. That was just a preview. Now the real show has started. The impact doesn't stop at Wall Street or Tokyo. When Japan shifts course, the pressure radiates outward, across Asia, Europe, and every emerging market plugged into the global capital machine. There are three major transmission channels. 1. Stock markets start feeling the gravity. When global funds suddenly need liquidity, they don't sell their weakest assets. They sell the most liquid ones. And emerging markets, whether in Asia, Latin America, or Eastern Europe, are usually first in line. Not because their economies are broken, but because global investors can exit them quickly. For years, cheap yen helped fuel growth across these markets. But when that money reverses, indices wobble, portfolio managers hit the sell button, and volatility spreads like a cold in a kindergarten classroom. 2. Interest rates rise everywhere. When Japanese capital becomes expensive, no country is allowed to ignore it. Central banks, big and small, have to react or risk watching their currencies weaken. Higher global borrowing costs lead to tighter credit, slower capital flows, and pressure on real estate markets that rely heavily on easy liquidity. You can't have a decade of free money and expect no consequences when someone finally turns the faucet off. 3. Currency pressure and imported inflation. When capital flows out of emerging markets, their currencies weaken. A weaker currency means imports become more expensive. Energy, food, manufacturing inputs, you name it. The result? Silent, creeping inflation. People don't always notice it at first, but month after month, purchasing power thins out, savings shrink, and businesses feel the squeeze. This is how a policy shift in Tokyo quietly ripples into daily life across continents. A new financial era begins. Japan didn't pull the plug on cheap money because it wanted to. It did it because 30 years of debt, demographics, and geopolitical pressure pushed it into a corner. And once Japan closes the valve, trillions of dollars that spent decades flowing outward start rushing back home. This isn't a temporary disturbance. This is the opening chapter of a new global financial cycle. One where money is expensive, liquidity is scarce, and every asset must prove it actually deserves its valuation. When a pillar of global finance shakes, the entire structure rattles. And whether you're sitting in New York, Manila, Jakarta, São Paulo, Warsaw, or anywhere else, this shift eventually knocks on your door. No one gets to sit this one out. So here's the real question. Are we watching the beginning of a deep, long-term reset in global finance? One that could reshape markets for years? Or is this just another temporary shock that investors will conveniently forget as soon as the next headline steals the spotlight? Japan has turned the wheel. The flow of money is reversing, and every major economy is bracing for the chain reaction. But what do you think happens next? Are we entering a new era, or just another market panic that will fade like all the others? Drop your thoughts below. Because if world leaders can't agree on anything, maybe the comment section can.